Tesla shares have gone from hero to zero over the past year. The combination of industry headwinds, demand concerns, and an unpredictable CEO in Elon Musk have weighed heavily on the EV giant. Some respite in today's session, though. We are seeing that stock up thanks to the continued efforts of Cathie Wood, yes, whose funds bought the dip on the day. The group shares plunged the most since 2020, and you see that stock up now about 3.5%. In October, S&P Global upgraded Tesla to a triple B from a BB plus with a stable outlook of improving production and solid cash flow prospects. So what is the outlook as things stand? And is there space for competitors to steal a march on the industry leader? Joining us for that conversation is Nishit Madlani, S&P Global Senior Director and Automotive Sector Lead. Good to talk to you today. Let me just get your reaction to the sell-off that we have seen in this stock. Yes, it has bounced back, but we're talking about a significant decline from the highs that we saw before. You think it's overdone?
Yeah, I mean, from our perspective, what I'd say is, look, when we upgraded them to investment grade last quarter, the key reasons were really around higher confidence around their long-term targets for production, but also the fact that we were expecting pretty strong profit margins and solid cash flow to continue. This is a company that's ended, the quarter with $19.5 billion of cash and almost no debt, and not too many companies have that level of cash as a proportion of their revenues. So what it does is it gives Tesla that much-needed dry powder to fund its global expansion in an industry that's notoriously volatile, right? So we've seen that with the recent demand concerns, which are adding to all the supply chain and logistical challenges that we think will persist. So we think there's a lot of cushion in the ratings, and that's why we have a stable outlook.
And despite a growth of 40% year over year when it came to deliveries, some disappointment, though, in the fourth quarter with some of the production failing to roll out at the pace that they would have liked. But when you look at some of the upside and downside risks, what are you honing in on from this point?
Yes. So to your point, I think, yes, we will say that vehicle sales did come in modestly below our estimates. The first 3 quarters were better and Q4 was somewhat weaker. I should add that, look, we're not looking at Tesla's progress in isolation, right? There have been things that could have been worse, and we don't want to hold Tesla to different standards if others in the industry are facing similar issues. I will say that for 3 years, demand has, far outpaced supply. And I don't think the Q4 data by itself signals a weaker credit story. So yes, there's pressure in China, but that's going to be existing for almost all automakers operating there. Big picture, I think what we look forward to is Tesla's commentary around order backlogs, just to better understand if demand will in fact outpace supply into 2023. And that's going to be the focus of their earnings 3 weeks from now.
I mean, so much of the focus around Tesla has long been about its leadership in the EV space. As you know, a lot of competition coming in online, especially this year. You've got this headline today, GM reclaiming the top title as America's top car maker. Obviously, they've got ICE cars as well. But does Tesla's pullback and some of the choppiness that we've seen with that company, does that give an opening to some of these legacy players who have been moving quite aggressively on EVs?
And that's a great question. And to be honest, that's a topic on which we spend a lot of time on the auto side here at S&P Global Ratings. And we try to build our credit stories around how different automakers are positioned for the future. The top things we are looking at is, the progress that the automakers have made on vertical integration and scale, because we think that is really the holy grail for success in EVs. So yes, a lot of them have invested adequately, we think, to maximize in-house production. They've tried to have more control over their supply chain. And to be honest, there's been a lot of investment in battery capacity as well. So I think there has been a lot of, multi-billion-dollar investment commitments made by automakers in recent years. But it is going to take time for them to bridge the gap as far as, getting the cost efficiency is concerned. Because remember, one thing that Tesla has going for itself is the way they've built manufacturing efficiencies. And that's what's led to its stellar margin and cash flow performance. And I think it's going to take some time before the traditional automakers get there. And of course, a lot of it depends on market acceptance. And that's a big wild card as to, what's going to be the acceptance rate for some of these launches coming up.
And we know that when you look at the broader space, Rivian also had issues meeting its production targets. They blamed global supply chain issues. How would you characterize where the EV market is and Tesla's strongest days of dominance behind them at this point?
Yeah, I will say, look, the industry overall is going to face a lot of challenges, right? There's immense pressure on Tesla to hold on to this first mover advantage. They obviously will need to make the total cost of EV ownership more affordable. And their Investor Day announcements on March 1st will probably provide more insights onto this. There's obviously the need to expand the range of products because, like you said, every automaker, startups are jumping on the bandwagon in the next 2 to 3 years. And what's interesting is that number of battery electric vehicles in North America is going to exceed 100 by 2026. That's over 4 times what we have in 2022. So yes, there are going to be winners and losers. And over time, it's the ones that build enough capacity and have the ability to pivot, that's going to really lead to the competitive advantage for the future.